The market is one candle away from a line that has called every major crash for the last century. And as we've been covering for weeks while markets were sideways, the supporting evidence continues to look horrible. Oil markets will have a shock headed into Sunday night's open with the latest strikes on Karg Island, and equities have been doing the exact opposite of whatever crude does. The million-dollar question is, how bad will things ultimately get? So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 7 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, I can't reinforce enough how nasty of a weekly bar this is. At one point, you have to realize that this upper wick, right? It suggested that we had a solid green-bodied bar that was actually over the weekly 20 SMA. It was over the previous week's open, over the previous week's close, over the previous week's low in the upper third of that prior range. It was also back over the bottom end of the balance range on the daily. So to finish the week with this nasty upper wick suggesting a massive rejection of that overhead supply, Thursday, Friday puts us right back down on the weekly lows, and then we close there. That's a really substantial rejection. So once again, structure this week is like shouting from the rooftops, hey, this is bearish, right? Very, very bearish close there on that Friday session. In terms of location, it doesn't get any better, and we've already sort of covered some of it, but on the bar-to-bar count, we do still have a lower high. We've certainly got a lower low, and the candle close is meaningfully underneath the previous week's range. We reject the 20 SMA, as we've discussed, and we've also rejected, once again, after reclaiming early on the Monday session, the bottom end of the overhead supply for an incredibly weak close. This is not looking like a healthy weekly chart in terms of following through on an uptrend, and instead, I would start to qualify this as a lower low in the trend count. As we know, we should really be starting to look at the next weekly target to the downside, which is here at 653. It would not be unreasonable for the market to get there in the coming week's worth of trade, as we'll see with the weekly expected move on the daily chart in just a moment. This also means if the weekly chart is going to catch a resting bar, a rally bar, something in the upward direction, would it not be beautiful for a potential weekly lower high now underneath that overhead supply? You rally back a little bit, maybe you produce an inside bar. If you could start to find the daily rejection of that level, there's your weekly lower high, and once again, these lows back here would be the downside target. If we take out the Fibonacci's from the low of this move up to the tippity top, the all-time high, you'll notice that this is the first candle close underneath the Fib 61.8. At least the week prior, we were kind of in no man's land in here, and as we've stated already, that upper wick was looking somewhat interesting in terms of a look below and fail. That is currently not the case, and the trend is drifting in the downward direction. If we take out the anchored VWAPs on the higher time frame, let's take a peek at these anchors. We are just rejecting the entirety of the overhead stack, and we've even closed underneath this anchored VWAP, which we haven't really tested in a very long time since the NVIDIA earnings debacle back here, November 20th of 2025. If we zoom out, just to give you a little bit of a reference, it is the breakout bar after the China deal to make a deal in terms of tariffs and trade over here post-April of 2025, right? So we're failing a number of key reference points. Let's also take a look at the high volume node in terms of weekly volume profile. There it is. That study always seems to hide there. We are rejecting all of the overhead supply. Once again, the upper wick there, and it shouldn't be much of a shock, right? Considering how long we went sideways for, that's where a lot of that volume transacted. We're dropping away from that. Now, we did park ourselves at a high volume node here, but notice underneath us, there's really not much until we come into this high volume shelf here. And what have we been talking about on higher time frame monthly charts? And now I'm not going to sit here and say like, oh, everything's fine and dandy. We're just looking for the monthly higher low. It's still bullish, guys. Don't worry about a thing. That's not the approach I'm trying to take, but if you're a monthly investor, if you're someone who really has a higher time frame approach to the market, you actually want to see a weekly downtrend develop, bringing us into the monthly higher low thesis, the mole thesis as we call it, right? Monthly MO, higher low, HL. The mole thesis here then turns for a higher low on the monthly, and the uptrend may resume. Why is this level so compelling? Because as we've talked about many times before, it's the Fibonacci retracement 38.2. It's also about a 10%, slightly more pullback from the all-time high, which aligns with normal market action, right? This is about 11.79%, call it 12% if you'd like, from the all-time high into that level, and we typically have about a 10% pullback, correction, whatever you want to call it, on any given year. So this is not out of the cards in terms of a downside situation for a longer term downside target, but then also remembering that the monthly trend will remain up there. That level is still around 615 to about 613, 612, depending on your daily reference. Let's clear this up. Let's take a look at the daily timescale, and let's start to get a little bit more granular here. So first things first, we should measure or at least evaluate this week's expected move. If you're not familiar with the expected move, it's this gray shaded area right here. You can check out the video tutorial in the top right hand corner. If we're contained by the upper bound, right, we certainly have the potential for another lower high. I would argue it's maybe even an equal high to the lower high that was set last week on the Tuesday session via the nasty inverted hammer there. If we're contained by the lower bound, it's fairly straightforward that is going to be a massive lower low in the trend count. Now also, remember on the weekly we just talked about roughly 653, that's right here. That's this orange shaded area. If I just clean up the chart, you can see it there now. The expected move is suggesting that we could move through that. Now in the intro, I also mentioned that magic line that has called basically all of the market crashes through the history of all of the market's history. And that level, of course, is the daily 200 SMA. It's the godfather moving average, if you will, that all money managers will use and say, okay, bullish above, bearish below. Now, I'm not going to sit here and say that the market must crash as soon as we crack that level. I'm sure you could go back and do your own studies on the 200 SMA, but typically, if we get a persistent downtrend underneath the 200, that would be problematic, and we're easily within, sort of spitting distance to that as of Monday's session. So the big things I'll be watching for on the daily timescale are really any lower high attempts underneath the prior week's low, not this week's low, but the week before that, so 669.75. Any lower highs here on the daily chart, really well received by the market, should go down to make an equal low, and then really through that, you come into the 200, and I would really start looking for the weekly equal low set from here, around that 653. That's the bear case. The opportunity here for a look below and fail is, in my view, going to be a little bit muted based on what's happening with crude. I don't think we're out of the woods on that. I think that we will have slightly higher oil for a longer period of time than many are projecting. We'll talk more about some charts there in a little while. If the market is going to prove me wrong on that thesis, that is fine. I will wave the white flag, and honestly, I'll be thrilled for the long-term accounts. That's fine. But if we get some kind of rally and higher low here, back over the bottom end of the multi-week balance range lows, which is really 675, I will start to become a little bit more interested in the upside, or at least more of a neutral market stance again. But based on the developments of last week, this has been a notable change in tone from this market, right? All of these prior moves into the bottom end of the balance bought back up. And then this time around, it was pretty much a rinse and repeat of last week, but the fact that we went out to these major new lower lows on the weekly, that's the problem here, especially with the close there on Friday being underneath or right at the low of that Monday session, right? So all things considered, I am looking for lower highs. The ideal lower highs underneath 669.75 on the daily. That then repressures these equal lows, 664. We'll see that on the hourly chart in just a moment. Underneath that level, looking for, absolutely a first test, like intraday. I would not be a new money short at the 200, but then through the 200, yes, absolutely looking for those equal lows on the weekly, 653 down to about 650.85. Let's go ahead and let's take a look at let's go over here to the hourly chart and take a little bit of a closer look at the price action from last week. So once again, very impressive session on that Monday, especially with the end of day announcement. Oh, look, the war is maybe going to be coming to an end. Then Tuesday, Wednesday, try to consolidate over that major weekly level. The Thursday gap and go is the pain point, right? And this is the difference in this market, right? You finally saw on Thursday's session a gap and go to the downside versus all of the other prior gaps, and really look no further than the previous week. You could even look to that Friday session prior, right? Here is the gap and fade, right? Meaning it comes back into range. Here's the gap and fade back into range. Even on that Thursday session of last week, we moved higher to close the gap before we actually moved lower, right? You could even take a look at Friday's session. We didn't really accelerate to the downside. We made a move lower, but mostly went sideways on that day. So on the Thursday session, the gap and go with the very weak close here was a change in character, which tells us underneath the weekly overhead supply, we're finally starting to run into some more serious sellers, unlike the prior examples. Certainly on the Friday session, you interacted a little bit with that Thursday gap, but certainly closed meaningfully weak underneath, not just Thursday's low, not just this, but also underneath the 664, which comes from prior. If we just look further left, There we go. 664 is this. It was really the neckline. And if I just zoom in here for a second, see this interaction there that goes from previous resistance acting as new support. That's a key inflection point. The fact that we're below that is fairly compelling for the sellers as well. Let's go back on over to more recent price action. I want to take out a couple of fibs here. They will look a little bit silly just because we've retraced more than it, but I just want to show you, right, that on that Thursday session, the fact that we gapped underneath the fib 38.2 after attempting to hold a little bit of a flag action there on Tuesday, Wednesday, that's pretty compelling for the bears. Obviously, closing below the 61.8 dramatically increases the 100% retracement odds. That's exactly what we got on Friday. If we come in here in terms of the major high, down to the low, doing something like this, notice that your fib 38.2 is right here. This is what I was sort of questioning. Should I do this on the daily? I'll just do it on the hourly. Nonetheless, 38.2 is right there. If you rally back, any rejections of this area, as we described, both on the daily and the weekly, this is now a weekly and a daily lower high, and that will keep the sellers in position for continuing the trend in the downward direction. Let's go ahead and clear up this fib. Let's take a look at our anchored VWAPs intraday and just get a quick glance at sort of the fact that, once again, you had a nice recovery effort over, this is the previous Monday's anchored VWAP, nice recovery effort in here, trying to sustain above, just couldn't really do anything with it, right? And as of right now, we're certainly underneath that Thursday gap and go VWAP as of Friday's week close. So no matter how I look at this picture, it's very difficult for me to want to see anything that's overly bullish. The only thing that I could maybe argue for here that the bulls could participate in, once again, it's not going to be enough to change the daily trend in the drop or at the drop of a hat, drop of a dime. But if you start to really extend into, we want the daily moving averages. There's the correct study set. If we drop immediately, let's just say that we get some sort of like gap down on Monday, and then we sort of fall further. Tuesday maybe gaps into here. If we could reclaim this area, I think you might be able to get a counter trend long going just for a retest of these lows. And then when we get here, right, it's the same old song and dance. You're just going to be looking for a potential lower high to continue the trend in the downward direction. We have daily downtrend finally. We have, or really I should say weekly downtrend finally. Daily trend remains in the downward direction with highs, lower highs, easily able to set new lower highs, noting that we're sitting at the lowest lows, and the hourly trend could not sustain up, right? This was a very short-lived attempt at flipping the hourly trend back to up. It's clearly back down with this as a lower high sitting on an equal low. It would seem natural that the next course of action is down. So that's what I'm seeing. Again, threats to this downside base case would be if for some reason we get who the heck knows over the weekend in terms of news flow. As of right now, the Carg Island strikes seem to be, there seems like it's going to be another hang up for the market, basically, with the way crude's been trading. Let's say something crazy happens over the weekend. Nope, we're all done. We're not doing anything else over in the Middle East, and the market gaps up to here. It's not really a true gap, but let's say we open here over these lows at 669.75 on Monday. Consolidation here would make me think, okay, is this some sort of a low over the 200? Maybe. I wouldn't be convinced. But if we were to get over 675, I would just naturally have to start changing my tone a little bit. Not a lot, but a little bit, maybe back to more neutral as opposed to outright bearish. Note that we would still just be underneath the 20. We're well below the 50 SMA. It does not really look all that compelling. That's what I've got for you over here. Let's take a quick glance over at the market internals. What do we have from this perspective? The only thing that I'm a little shocked about is the volume flow on Friday. We did not see substantial volume outflows, even though we did on Thursday with the gap and go. That's fairly natural when you gap away from a range. But the fact that Friday's selling was pretty persistent through the session and did not close strong by any stretch of the imagination. There was no short squeeze into the end of day where shorts had to de-risk into the weekend. This to me is a little bit of a head scratcher on the volume flows. It's not enough to make me feel bullish or overly divergent, but it would just be sort of a signal to say, if you get the big gap down situation we just talked about over on the hourly, let me just do that one more time. If we gap down to here and then gap down to here, and the volume flows are still not really aggressive to the downside, we might be in store for a little bit of a snapback rally to go counter trend, right? Not going to change the trend, counter trend, but rally nonetheless. Let's go back on over here. You can see the same thing in the AD line. Notice, though, how weak the cumulative index score was on the session. Cumulative builds on the tick, also in the downward direction there finally, after a more mellow Wednesday as the market technically went sideways but closed a little bit on the weak side. Let's jump on into the market profile here for the S&P. And what I just want to point out is that earlier on in the week, the market was really reluctant to actually come in here and close those single prints. We talked about that on Wednesday. So the fact that the Thursday session gaps through it and we did not go back up and test, the fact that that gap is unfilled on Thursday session is quite notable, pairing it with the single print argument here. Now, on the Friday session, notice that as the market tried to rally early in the morning, there was no value built out. Higher value is not quite clean to the downside, but it's certainly in the lower direction as we compare to the Thursday session, showing a little bit of improvement from the sellers rather than like over here, right, where I would say mostly value is still above here, primarily the single prints, meaning that this was price acceptance closer to these highs, right? If you're not familiar with market profile, by the way, check out the video tutorial in the top right-hand corner, and let's move back on over to the platform to take a glance over at the NASDAQ 100. I'm not sure if I also pointed to this tutorial, top right-hand corner for internals, but if not, there you go. Hopefully the two flags don't bump into each other and cause an issue. Let's go from there over to our NASDAQ on the weekly. Let's keep moving through this. And of course, really, I think the bulk of why we're going to continue to remain bearish here will become evident in the supporting evidence categories. So let's make sure we can at least stick through to then. Let's take a look at the NASDAQ, which notably has a little bit more in terms of relative strength. Now, the weekly structure is, by no stretch of the imagination bullish here. Look at the huge upper wick, fantastic for the sellers, right? Big rejection of the 20 SMA, technically a bar-to-bar lower-ish high, technically a lower-ish low, but mostly inside, right? This did not go out to a major new lower low, which we'll see on the daily time scale in just a moment as well. We know that the NASDAQ has been in a little bit more of a sustained downtrend for a little while now with lower highs, and we've already seen lower lows over here. I would think that the next major target to the downside is closer to about the 580 level, which may produce some confluence with the weekly 50 SMA over the next handful of weeks. Doesn't have to be next week, but perhaps even the week after that. So if we can continue into that low, there we go, then this is the first target, and I would still be expecting that if the market wants to make that 10% plus correction, you're still looking at your prior highs from 2024 rather than just calling it wraps here at the weekly 50 SMA. If this is all overhead supply and it continues to buckle, again, you've kind of got leeway to get into those prior highs. So I don't really see much in the way of bullish strength here on the weekly. If we break out the Fibonacci's, you'll see a lot of the same stuff here as the S&P, of course. There you have it, your Fib 38.2, confluence at the prior high. If we just clear that up, coming in here a little bit more closely. Let's come from the highs to the lows this time around just to give us a little bit more of that bearish taste. You could just continue to see the rejections in the upper wick alongside the 20 SMA on the weekly of the 61.8, which is bearish. Let's take a look at the volume weighted average prices, anchored view apps. There we go. Underneath the majority of the stack, once again, I would say the same thing in terms of structure. You have to remember that on the Monday session, this was a solid green bodied bar. Look at that. Oh my goodness. Maybe we can get Brigade Bolt up and over the top end and go back into the equal highs. Nope. Sayonara, try again. Looks pretty weak, closing here underneath the majority of the stack. And once again, simply put, it's just a rejection of overhead supply, which we'll see as we break out the volume profile on the weekly. Let's do this. And you can see it. We have closed again underneath the bottom end of the range there. So not really looking great for the buyers here. I would expect lower. You do have that same sort of lowish volume void here with these prior highs acting as the target. Let's take it on down to the daily time scale for the Qs and take a look at the weekly expected move. Once again, that's this gray shaded area right here. And the upper bound is going to be at 613.65, kind of equal highs to last week, still slightly lower high from the top end of what I've been considering the micro balance range in here. And then the lower bound is down there at 573.79, of course, just a notable lower low. Now, in the Qs, we're actually closer, I think, to the 200 SMA actually breaking, right? You could start to see how, although we did not take out these lows, we did close meaningfully underneath that 595 level, which if we take a look at the hourly chart, is the correct inflection point coming from back over here, and then it's the opening print of that Monday session loosely, rather than actually focusing on the dead low of those moves. So the 200 SMA is likely just to be confluence early on Monday morning, right at that 592 level. If we take that out, that of course is bearish. Now, of course, I would just consider this bearish consolidation anyways, underneath 595. Let's go back to the daily so we don't get ahead of ourselves and we could see where these prior left side references are actually coming from. We've got 583.50. If we take this out, once again, you could look like consolidation here, take it out, equal low is certainly the target here. If we rally a little bit, I would still be on the lookout for daily lower highs. Remember that on the NASDAQ, we have highs, lower highs, but equal highs, lower highs, but equal highs. You could still set a lower high here coming from the equal lows in the market. Right? So anything that is a gap fill reversal underneath the Thursday gap down, or rejection of the daily 20 SMA, if you will, is still going to keep me slightly more bearish biased on the NASDAQ 100. If we get that lower high and come into the equal lows, It's just the same thing we've been talking about for weeks now. If you can produce lower highs coming into the same equal lows, the odds of this low breaking at some point dramatically increase, so the trend can just continue. Remember, trends are comprised of lower lows and lower highs in the case of a downtrend. Not to insult anybody's intelligence, right? But we don't have that yet. So if we continue to get a lower high, the pressure's on. The bears will likely go out to make a lower low. The buyers will dry up a little bit, right? The lower high tells us that buyers are making less and less progress. If we continue looking to the left for references to act as potential support, confluence with the lower bound of the weekly expected move is this launch point from over here. The reason I call it a launch point is because we gapped up on this session here that was going to be on September 5th of 2025. We gapped up. We didn't make a new swing high, but we gapped up and then offered gap fill reversal. That's where the rally sort of stemmed from, right? Yes, you could use this low, and that's why it's still mapped as support, but this inflection point, the gap fill reversal, is what matters most to me. That's baked in there around that 573.75 mark, right? So that is the next downside support at the bottom end of the range. If we need lower targets beyond this come Wednesday, we'll update this in the midweek market update. If, of course, the market is going to rally and throw everybody for a loop, if we get sort of look below and fail on the 200 and we're here, I would still be more open-minded to finding a lower high at this level. 605 is the gap fill reversal. The part where I really start to change my tone is if we come into this lower high area, do this, and then bounce for a higher low without overshooting, 595, that would start to look like a potential higher low. From there, we'll be back on the lookout for a potential follow-through day, which we talked about on Wednesday, FTD follow-through day, if this look below and fail of the daily 200 actually starts to materialize. As of right now, I would consider this a lower probability threat to the base case being looking for slightly lower into the coming week's worth of trade. Let's clear this up. We'll do it on the hourly just to be sort of congruent. I was just going to break out the fib. Remember we had that? I'm remembering what was happening. 7 minutes ago? Anyways, there's the fib 38.2 from the top to the bottom, sort of confluence with the top end of the super micro balance range. This is the micro balance range, and the macro balance range is really this, right? So confluence there, I think it still suggests a lower high. I think it still suggests staying underneath the 50 SMA, the blue moving average. Let's clear this up. Let's take a look at the intraday anchored VWAPs and quickly get a grasp as to where we're at from here. We're getting great confluence at that lower high zone. So once again, if the market bounces off the 200 and comes into this, I'm still thinking about lower high threats for shorts up against 605, retargeting the equal low of the range, right? If the market is going to continue underneath the 200, right, lower highs here will just naturally be underneath the entirety of the stack. I think we've done a pretty decent job of the pathing ideas already, but once again, rallies that reject in here are a lower high. I would then expect higher odds of breaking through. When we get here, any lower highs that then form next should be here and seek continuation of the overall trend, right? That's how that naturally works. If the market gaps down under the 200 and can extend into the 583.50 area, I would start looking for this, and then this is where you'd want to stage that next major lower high short underneath the overhead supply. If the market can go gap and go to the downside underneath 583.50, equal low target at the bottom end of the weekly expected move with the confluence from that level we just described as the inflection point on the sort of September rally, if you will, is up next as the target. Now, when we get here, if it's a gap and go, I'm not sure I would be a new money short into that level. I would then be looking for a lower high on the gap and go, right? Basically, just understand sort of like the rubber band thesis, if you will, the rubber band theory for the market. You get a little, even though we're bearish, right? You don't want to get too far ahead of yourself. Otherwise, inventory is overly net short. Someone gets hurt from the lows and it kicks off a short covering rally, right? So that's what you want to avoid, being short in the hole at the bottom end of this move. All right, let's move from here over to our NASDAQ side of the market internals. And we'll do this real quick. Same commentary as the S&P 500. I'll save you the breath, right? Could have been worse. Could have been worse. Definitely was bad on Thursday on the gap down, right? And certainly bearish over there. Let's just jump on over to the market profile. And again, it's going to be basically a rinse and repeat of what we've got going on here. Value was sort of sideways on that Tuesday, Wednesday consolidation, clearly breakaway to the downside on Thursday, and then on Friday down as well. Just note the point of control shift in the downward direction. We do have a slightly poor low, an INM period on that Friday session. I actually didn't check the ES at the low of day. A little bit more meaningful excess, M and N. Maybe, yeah, M and N period, lack of material excess dead on the lows would indicate that we might need a little bit of repair down there. So what that suggests is lower, right? You need to break through that to actually repair it, and then it's just, do we stay underneath Friday's low? Of course, that's more bearish. You've got a little string of single prints in C period over here. Did we have that over here? Little string of C period single prints. I think primarily I wouldn't be as concerned about the singles as I would be just sort of watching the major inflection point lows, right? The singles kind of matter when you're maybe not close to other key structure and you're looking for an inflection out of the market. But if we just go back over here, I mean, sure, you've got your single prints in there on Friday, but I think everybody knows that we'll be watching this, right? And it's really more about 595 rather than the closure of singles, which would maybe be something closer to about 598.75, right? So an arbitrary lower high there. If you wanted to read into it as a single print rejection, great, bearish. I think naturally just being a lower high and then breaking the range low again would open the door for downside anyways, right? So that's what we've got on the NASDAQ side of the market. Let's get on over to the IWM. Let's finish up the big three here with the small caps and see what's going on from a weekly perspective. The Fed rate cut odds have pretty much been decimated to the point of, you're not getting any rate cuts until late, maybe one into the end of the year come October or December, right? So as of now on small caps, we've clearly failed the overhead balance range. In terms of candle structure and location, let's just be congruent here. Same story, right? You've got this nasty inverted hammer, huge upper wick, but notice the difference here is that the upper wick actually does not even suggest a reclaim of the bottom end of that overhead supply. Instead, it's actually a perfect lower high right at the level. So that to me is notable, and it is a bearish indication. Any rally attempts should continue to find a lower high, and then suddenly we're starting to look more like a head and shoulders rather than a continuation of the trend. Now, I wouldn't throw in the towel completely, noting that we're over this previous left side peak. If the market can start to find a little bit of a footing in here, that might be a bit more healthy. It's not going to do anything to change the immediate trend. I'm just saying it wouldn't be unreasonable for after a 2-week down week, or a two down week series, I should say, it wouldn't be unreasonable for a little bit of a counter trend. I know we got it in that big upper wick, but it wouldn't be unreasonable for a little inside bar here and then some sort of thing that looks like this. Now, of course, what do we have this week on the 18th? It's none other than the FOMC. So that is going to be a huge deal for small caps. And the only positive thing I could see Jerome Powell maybe pulling out is like, we're not going to look at oil prices as being inflationary, which it's an absurd thing to say in my view, but nonetheless, that's certainly how Kevin Warsh feels, and it's what a number of Fed commentators have said over the last couple of weeks, 2 weeks to be exact. You can see on the anchored VWAP stack a rejection at the bottom end of the overhead supply, so great confluence there. Once again, a bearish data point. We've closed underneath more meaningful amounts of these anchored VWAPs now, so it does not look good. Let's take a look at the volume profile on the weekly, zooming back out, and we could see here, really, like these left side peaks are all kind of equal-ish. In terms of volume, this is fairly equal to this, fairly equal to this. It's not like it's a huge low volume void or a huge high volume node, right? So it's potentially an area of support zone. You might be able to call that in there, but it's certainly not my favorite area. We could come in with sorry, I did not mean to say not my favorite area. It's an okay area is sort of what I'm saying. Fibonacci 38.2 is below that, more aligned with this low. If we come in from here to here, as we know, we are underneath the Fib 38.2. That was the same data point as last week with the close underneath, and this is just a threat of the 61.8. I will say, and let's just actually go take a look at it on the daily time scale, we do have thin structure underneath us. Here are the small caps. Here is the rally that sort of kicked things off, very linear in terms of the move there, very symmetrical, this move and this move here. But notice that if you break these lows, there's nothing there until you get back down to the low. Here, maybe the breakout point at 239 is a potential area of support near the 200, but this has been a pretty nasty downdraft and loss of the overhead consolidation. If this was going to be a healthier market, in my view, you probably wanted to see like look below and fail, stays up here, and then starts to push out in the upward direction for something like a weekly bull flag break. That's certainly not what we're getting. In terms of last week, it speaks for itself, right? Big rally straight into the overhead supply. I know we just saw the same upper wick on the weekly, but becomes even more apparent on the daily, right? Right into the overhead supply, rejects, breaks down hard on that Thursday session. The only thing different here is that on Friday, you didn't really go out to a meaningful new lower low like you did in the S&P. So just making a small note of that, it's a minor data point. It's not something I would really lean into hard on the long side unless we get a look below and fail, and then we're here, short-term hourly inverted head and shoulders. This becomes maybe the sequence for a reversal, but for now, I would think bearish consolidation, even rally attempts before a break, just set a clean lower high that could potentially be underneath 254.50, equal lows, break that thin structure underneath as we described into the 200, if not further towards this 230, right? Expected move here, just to read out the numbers. Apologies if I missed that, but 256.96 on the top side for the IWM, and down here 236.22 for the bottom side, overshooting the daily 200. Let's take it on down to the hourly time scale, where we will do the same thing. with our Fibonacci's from the all-time high to this low, you are getting a perfect rejection of the 50% retracement. So really, there's only 3 fibs we pay attention to, 38.2, 50, 61.8, and you are rejecting the midpoint of that range. Certainly could suggest another lower high on the daily under the fib 38.2, in which case all of this is just going to become bear flag consolidation, right? Let's clear that up. Let's take a fib from the opposite sense from here to here, just making note that if you stay inside the Thursday-Friday range, you're consolidating in the 61.8 zone, which is just bearish nonetheless, right? If you want to be a bull here, you probably want to see something constructive, get out of the 61.8, produce consolidation here, and then maybe with some positivity from the Fed, you're up and over that big area here around 258, my apologies, 258, and something more positive happens. But again, we just don't really see, I personally don't see it in the pipeline, right? Even Jerome Powell can say all he wants that, oil prices won't impact their view of inflation, but I think the market's going to price it in anyway. So that's going to be a moot point, ultimately. Let's take a quick glance over at the, we want intraday anchored VWAPs. There we go. They're just, raining down on price action. Plenty of room here for a lower high. Does not really concern me in terms of a major bullish reversal. That is what we've got. We're just now breaking from overhead supply, right? This is the first lower high that was set. Let's see if we can go out and make some lower lows. That's the small caps in a nutshell. Let's take a peek over at the Russell internals. Same story. I'll save the breath. The only thing I will make note of is that Thursday's cumulative build on the tick was really not as bad. That's the one thing that I think is slightly different here versus the others for small caps. Does it derail the thesis that the bears are taking control? Not really, in my view. I would think that the Wednesday consolidation happening here, if that was going to stage a higher low rather than just, head and shoulders, right shoulder, this should have been a stronger cumulative build on the tick, and it just didn't happen. Let's go on over to the market profile of the Russell. Let's take a look at this over here. We've got ourselves just total bear consolidation on the dead low from the Friday session. All that means to me is it is possible if shorts are located down here, they're going to be disappointed on any sort of Brigade bolt over that. So I would think that you don't want to be short smack on the low of this move until we get Brigade bolt lower high underneath. If we're just in here, I don't know about being short ahead of the move. It to me would seem like, okay, if you're short in here, look below and fail, it's going to trigger a short squeeze, in which case we know there's room for a lower high, which maintains the bearish stance on the hourly and the daily. It also means, right, so put yourself in both sides of the trade. If you're short from here and we squeeze, you're unhappy, right? You're like, oh, that sucks. Got to close out positions. You add to the buying pressure. If people are long from here, they're going to be plenty happy and they're going to say, okay, great. And then where are they going to take profit? Possibly at some upper targets. So what you really don't want to do is be poorly positioned off of this low. And primarily the threat to me seems like it's the squeeze side rather than the short side coming into an equal low area of support, right? Versus like, if you're long here and you start to see the breakdown, right? I think that's a little bit more natural where, the short opportunity is just the Brigade bolt lower high underneath, but opening above the level, I think the risk is for shorts is what I'm trying to say ultimately, right? Lack of material excess on the low of day, poor low over here, could use some repair. That would easily set up the squeeze in my view. If you needed to repair the structure and you quickly came back into range, this is where tempo and sort of, knowing how the markets trade here, small caps in particular, if you know the tempo, the characteristics of smalls, if you get that quick flash in the pan that does not materialize lower early in the session, remember, small cap's character is to make a quick morning move and consolidate the afternoon, or do nothing all morning and a sharp afternoon move. That's usually how this thing goes, right? So if you get that quick break and then you quickly come back into range, you're probably headed north. You're going to get a short squeeze. Right, so that's it on the small caps. I think it's worth paying attention to, especially with the Fed sensitivity as we roll through this week. Let's get back on over the platform here. Let's start to get into some supporting evidence, which unfortunately isn't going to be all that compelling for the bulls. As we take a first glance over at the sectors, who's leading, who's losing, and where's the weight? Semiconductors still at the top of the list here, up 3.08%, but as we know, it's still a counter-trend rally in the face of a developing downtrend. Energy catching a bid here, of course, with what's going on with crude, up 1.5%. It's technically a little bit more inflationary, not really risk on. Utilities, definitely risk off. XLK honestly closes green. It's an okay look, but honestly, the structural chart is going to tell the full story. Software got wrecked this week, down 3.29%, giving back some of the gain that it had over the last couple of weeks. Not the end of the world, but you have to remember, right? That's still a weekly downtrend there. XLI, 8% down. Financials, really the worst looking chart for the sectors right now. Discretionary not looking great. Communications still neutral, right? So the posture here is kind of a mixed bag, but the structural charts will tell the story. Here we go. Let's take a look at the SMH, right? What do we have here? Well, to me, it just kind of looks like a head and shoulders, and this is a lower high, rejecting the 20, back underneath the 50, and if you come into these equal lows, you could quickly kiss this thing goodbye, and you're looking for some further downside, right? That to me is a totally reasonable situation here. We had the NVIDIA earnings sort of like, dare we even call that a blow off top? It's not really, but you get the idea. NVIDIA earnings gap could not save this, and now we're lower for a lower high. This is a trend reversal, right? How is it not? You have lows, this is a lower low. You have highs, this is a lower high. You're in a downtrend on SMH, even though the weekly performance is green. It's because of the gap down on the Sunday night open, right? Let's go on over to energy, and what do we have over here? Not really looking like a big short. I would just look for consolidation and continuation. The one thing I would just caution folks of is if we get the Sunday night futures move in crude and we gap up, that probably fades out of the energy sector itself, right? So just be aware of that. Don't. I would not chase a gap up in this uptrend right now, given what's going on with crude. It's going over to utilities. This still looks like a cup and handle opportunity to me, in which case, if this breaks for higher, that will be defensive. Utilities are a defensive sector, and they're trading near all-time highs as the market's pulling back. As we jump on over to the XLK, once again, green, but don't let it deceive you. Does this chart look good? Nope. It closed underneath the daily 200 SMA as of Friday. That is the first close under the 200 since, I believe, the April tariff tantrum. Yes. Right? First close below the 200. So not looking great. Looks just like the QQQ. You could even strike a trend line here. There it is. As long as you're below that, there's nothing really bullish going on here. So I'd be thinking about the full gap close and just acting as a headwind to the S&P. Here's software, a little bit sharper of a pullback than what I would have liked to see. If this was going to be mild into a bull flag, I think that the what would that have been, Tuesday session really should have been the quick little look below, more so sideways session or two, and then higher into the 50. This doesn't look great. I mean, I'm not going to say it looks horrible, but could you yield the higher low here? Maybe. I'd be a little neutral-ish on this IGV. I don't necessarily think it is the worst looking chart in the world. I think that these lows may end up sticking as the lows in software. I just don't understand, not that I don't understand, but I wouldn't see it as being very reasonable that you've done all this volume down here and suddenly you're not going to be building out some kind of a low, right? So I don't, you might be able to, you could see it, sort of hear it in my voice, not see it, but hear it. You might undercut this by a little bit, but I don't think we're going to have another one of these moments, basically, in software is what I'm saying. This seems to me like the place where it should based on what's happening with volume. So should and what it does do are two totally different things, but for now, I would just really pay attention to the 20 early on in the week. If we're above, neutral, maybe looking for this to continue into the 50. If you're below, yikes, that's just going to be a little bit more of a headwind to the overall tone of markets. Let's go on over to industrials. What was looking like a really beautiful trend here had a nasty and sharp pullback. This has failed the 50 SMA. What we know about markets, so I'm talking back about the index product, you're not going to have a huge, 10%, 20, 15% correction unless you have what we call no hiding, right? If there's no hiding and everything is red sector-wise, then yeah, you're going to get some downside in the market that can actually get into those 15%, 20% levels. And this is not producing clean higher lows. If we were going to have sector rotation, in which case the market maybe goes through 5% correction, 8% pullback, something like that, then you would just catch yourself for a higher low. You'd continue to rotate here as as tech finds its footing, then maybe starts to move higher. So tech starts to move higher. This starts to move lower. That's how a rotating market stays healthy, and that's how you stay near the highs. That's what we basically did from, October to what we want to call it just a couple of weeks ago, early March, before the breakdown really started. The market was rotating. As of right now, you're starting to see some signs of no hiding. Let's go on over to financials. There's no hiding over here. This is a horrible looking chart, huge overhead supply, second heaviest weight sector by market cap. I don't know how you can slice this other than bearish. This looks horrible. Look at the close on Friday. A little bit of a rally, immediately rejected back down towards the lows. 2-day equal low flush point, second heaviest weight sector, kiss it goodbye. Under 48.40, huge headwind to the S&P. Let's go to discretionary. Does this look good? Absolutely not. Lower highs in here, making a new low, breaking away underneath the 200 SMA. Just ugly, ugly stuff. Does not look good through supporting evidence. Communications starting to head south out of this neutral balance range here, rejecting the moving averages. Still over the 200. We'll give it some credit. We're still inside of this as a range, but it does not look like a good or healthy chart. It looks weak to me. Let's go on over to the XLV. Once again, a more typical defensive sector is breaking down. So I just point once again to the fact that rotation is not happening, and instead we are getting that no hiding situation, in which case, if everything's breaking down, even healthcare, you get to your 200, you're going to experience some pain in the S&P 500. Let's go on over to the XLP. Another one, no hiding, right? This is really, I hope people truly make it to this point in the video, because the sectors in the under the hood look, yes, price is what pays, but this is what gives you the confidence to say, okay, yes, we are going to take that short up against a lower high, or no, we're not, because things still look good, right? This should give you confidence on the short side. You should look at this and say, wow, that's a really sharp pullback. This could easily start to yield a lower high, and if this breaks down with tech, then there's no hiding. There's no rotation going on, right? That's bearish. Let's take a look at the MAG7 ETF. Ouch. Rejecting the 200 SMA, rejecting all of the overhead supply, equal lows, asking for a break to at least close the gap, right? That is not all that unreasonable. This looks bearish to me. You could go gap close and rally, and then what do we still have? Barreling down 50 SMA, lower high in here, still on the table, underneath the 200, very hard to get all gassed up and bullish about MAG7. It's going over to real estate with rates exploding, right, to hedge against inflation, the market's trying to price that in, you're back inside the balance range. So just like you had a look below and fail here, you have a look above and fail. Do we need to rotate all the way to the bottom? Well, with the way that rate cuts are being priced right now, it certainly seems reasonable. Let's jump on, what does this mean for the broad market? Probably not much, just because it's such a lightweight sector. And the same thing here in the XLB. There is no hiding in the sense that this is a bearish breakdown. You are getting a bear flag under the 50, clear loss of the 20. This overhead supply rejected cleanly for a lower high, right? So this looks bearish and there's no hiding, but this is the lightest weight sector by market cap, so it's probably not going to move the needle. I would just say that there's no real rotation going on, and that's the main story really through the S&P sectors. Let's get on over to our sector ratios, and I do have an interesting, maybe not interesting, but just I want to point out the energy chart here for just a second, so bear with me for a moment. If you're not familiar with ratios, check out the video tutorial in the top right-hand corner. This just looks like a lower rejection coming in at the 50. I do have to give some credit to the XLK trying to find a little bit of an uptrend happening here. I'm not fully convinced until we get over the 50 and until the structural chart actually suggests that there is some sort of a turn coming in. This looks absolutely abysmal. XLC, as it goes sideways, will continue to give it that neutral data point, but it's not great. XLY, horrible, still telling us risk off. I'm just going to say RO. I know that could stand for on, but it's risk off. You're hearing it verbally. Same thing here in utilities, risk off. Let me open up energy. What I want to talk about on energy as a ratio is... let's go out to, let's grab multiple years here. There's a couple of things, right? Maybe let's even go to a weekly chart. Let's go to a weekly, and here we go. So this is kind of what sparked the inflation concerns, well, alongside the massive money printing, right? And that's probably why the Fed is going to say, oh, no, money printing is what causes inflation, not, prices at the pump. They would say that that's transitory, right? Anyways, if you look at XLE, I mean, certainly that's an inflationary pressure. This is why we, not... correlation causation, I'm going to say this is why we had the bear market of 2022. You could argue with me all day long if you want in the comments section. That's fine, whatever. The point is that as energy breaks into an uptrend, that is not good relative to the S&P 500. It is inflationary, right? If you take a look at what's going on over here, we just broke a multi-year downtrend, right? And, even forget about this and forget about the money printing that was going on there. This is clearly a change in character from what we had here. Right? What did we have in 2025? Where is it? Where am I going? I want the sort of summer of 2025 when those strikes were, just very precision, in, out, overnight, done, right? In the Middle East. The market's saying, nope, this is way more than that. And obviously it's been way more than that. It's been 2 weeks. And the energy prices are responding in this way. This is a headwind. This is bearish to me. And it supports what we're about to see if I just do this. We'll get there in a moment, but let's just go over to rates for a moment. Why are rates doing this? Because they can see what's happening with crude, right? They can see. It is, nobody's blind to the fact that crude is ripping in the upward direction and will likely move higher again on Sunday night. Okay, so that is that's the take there on the XLE zoomed out ratio chart. Let's go to the classic AB sets here. This does not look great. This looks bad. This does not. This looks maybe okay. Let's go neutral there. This looks bad. This looks bad. This looks bad over here. So not really a risk on environment, and I don't think we need rocket scientists to really be able to tell us that, but the charts are just confirming, right? There's no secret hidden divergence. That's nice to know. In terms of the gold chart, this does not look like it's doing anything impressive. It's sitting on the lows, which just to me looks bearish. Let's take a look over here at Bitcoin. We did close the week with a bullish Sailor Shift tool. This is the only thing that the bulls might rest their hat on. As I look over on another screen at some spot prices here, we're right at, it's got to be 70,750 as the key level on Bitcoin. The futures will be slightly different, but 70,750 right around in here. If you could hold above that, maybe we start to get a little bit more of a counter trend. For now, not quite fully on board. As we look to the TLT, I thought that there was maybe a small shift in character on the break of these highs. Clearly not the case into the end of the week. Still underneath the 50 SMA. It will really require not just a shift in character under the 50, but over the 50 for me to start saying risk on. So once again, another set of data that does not align with what's more of a bullish take on the market. Dollar ripping higher, rates rip higher. That makes sense given everything we know about the situation in oil, really. Let's go inverted ZT. Let's talk about some fundamentals first, and then we'll jump into the technical supporting evidence. Big break here is telling us that we should not be expecting rate cuts like we were before. And once again, looking at the Fed Watch tool, that has been baked in almost entirely. As we look to the end of the year, this is where the rate cut is set to take place, and it is the final month of 2026. Remember, we were pricing in 2 rate cuts, with one as soon as potentially June, earlier on in the week, if not just the week prior. The market is now saying absolutely not. You will be lucky if you get 1 rate cut. That's what the market is saying as of right now. And as we know, that is a headwind for small caps. That is a headwind for non-profitable companies. Higher rates means margin compression or just less profitability, right? The market wants lower rates. It's a fiend for lower rates. And as we take that expectation away, we are certainly seeing that align with the bearish breakdown we've seen in the charts, right? So that is what we've got on that front. Here is the economic calendar from last week, just pointing out that the PCE number here came in line with expectations. They cooked it right to perfection. The preliminary GDP number was incredibly weak. Markets did not like that, of course, as an additional data point. The JOLTS labor openings, I don't think that's what really moved the needle a lot on the 10 o'clock sort of release on Friday. I was a little impressed, honestly, with what's happening here in preliminary inflation expectations. Remember that these surveys are conducted like in the 2 weeks prior to the release, right? It's the first 2 weeks of the month. And for now, like, this is not what I would have expected considering what's happening in crude oil. Right? I would have expected this number to be off the charts, literally, like, 5% plus. We just opened this up. I was expecting, wow, we should be like here, right? And that's just not the case. It actually came down versus prior. So, in my view, that's not really, this is prior preliminary is what I'm saying. This, of course, was revised, right? If you just hold your cursor here, come on, revised from 3.5%, right? So down 0.5% on the preliminary last time, right? Point being is, this is a little shocking to me, the 3.4. I don't think it's going to mean enough to actually change the tone of the market, but that's just what we have. In terms of what's next this upcoming week, I don't think the market cares much about this. It's all focus on the FOMC. How could it not be? The FOMC here is going to release a new SEP, Summary of Economic Projections, and that will detail how the Fed is thinking about inflation and really inflation, labor, and rates over the next, their projections go to the end of the year basically, and even out to longer run rates. This is going to be huge, right? So the market is going to be everybody watching all at the same time, 2 o'clock SEP, and then of course any commentary from Jerome Powell, which should also be interesting, but expect a lot of deflection, a lot of dodging. We don't comment on this, we don't comment on that, we don't comment on these things over here. We just focus on monetary policy. Expect a lot of that. He will not be opinionated on everything happening. Maybe he mentioned something about crude. I would really venture to bet that he stays as far away from that as possible, even though the reporters will be all over it, right? So join us live here on the channel at 2 o'clock. We'll probably start 1:45 on Wednesday afternoon for the live streaming of that event. As we scroll down to Thursday, usual stuff, jobless claims, nothing on Friday. That is the week ahead, and primarily it is this as your main event. What does the Fed have for us on Wednesday midday? Let's jump on over to the earnings calendar. Some interesting names here reporting this week. I'd say Oklo honestly gets a little bit of an honorable mention. The chart looks brutal. I really want Oklo to be a short, and it was a beautiful short actually on Thursday. Shout out to a couple people in the group who caught that, even using like OKLS, for example, the levered 2x ETF. Nonetheless, Oklo earnings this upcoming week. Lulu, possibly interesting there. We'll see what the Lulu to barrel of oil price ratio ends up looking like. What else is happening over here that's interesting? I saw Micron, of course, that is the top priority on Wednesday after the close. Micron earnings set the tone for memory complex. They'll let the cat out of the bag now. SanDisk and MU are two of the trade ideas in the later stages of this video. Red Cat is going to be interesting. See what happens with them. That's mostly what I think I'm interested in. Perhaps FedEx usually tells us a little something about the state of affairs, if you will, economically. Fly, perhaps. We'll give that one an honorable mention. Big gap up on Thursday. Gemini, they've really been lagging big time as it relates to, Coinbase, for example. Maybe Alibaba. So there's a couple of honorable mentions in here. I'd say if I had to just pick a few, it'd be Oklo, it would be Micron, and that's probably it. Those are the two biggest ones that capture my attention. All right, so there's your earnings calendar. In terms of what's going on in the earnings call, certainly we're through a bulk of the earnings season, so I don't want to get too deep into the analysis of this stuff, but I thought this was interesting. The number of companies citing AI on earnings calls has certainly, right, if you see the S&P companies citing AI on earnings call versus S&P companies not citing AI on earnings calls, right? So the more recent is this, where is it? What am I looking? Oh, so sorry, I'm gathering my... reacquainting myself to this chart. Average price since March 31st, 25. So basically a year ago, right? Versus September versus December, right? What is the market doing? Before, if you talked a lot about AI, huge reward, right? Your company's up 25% since then. If you start talking about AI now, you're actually underperforming companies that are not mentioning AI. I just thought it was a reinforcing data point here that was somewhat interesting, noting what we've been talking about with CapEx. Right? The companies who have not talked about huge CapEx, who have not been talking about AI, are outperforming. And look no further than a lot of your consumer staples companies, your materials companies. What else fits that category? Utilities, energy, right? All those names doing quite well. That's why this is the way it is. Let's continue along from here. Just an interesting data point. Let's keep going, though. Let's rip through the supporting evidence and finish up on a strong note. Bond relationships, they continue to move in the wrong direction in terms of wanting to battle against inflation. This is, dare I say it, suggesting the bad S word, stagflation. Let's jump into, so that's a bearish data point, right? Credit spreads overall continue to move north. This is a risk off indication. That is bearish. Let's jump into HYG. Bonds in isolation continue to make more meaningful lower lows. You could just see here, if I make equal zooms on this, there we go. We do have a more meaningful lower low. Notice the slope of that line versus the slope of this line here. Much, much steeper, right? So that's bearish. Let's continue along. Anything else? Let's go to total breadth. Is it deteriorating? Is it getting better? Is it getting worse? I've got to readjust some of these panes because I do want to be able to see new highs versus lows. There we go. These certainly look bearish. Oh no, it's going to break. Oh, it's going to break. Thinkorswim. Why do they have to do that? Breadth looks bad. You're deteriorating on the moving average screens, certainly downtrends here. You're underneath the zero mark on the new highs versus lows. The RSP, unfortunately, oh, please play nice. We'll just zoom into these things full screen. This is a lower high. It backed away from its breakout point. We know that we're clearly underneath these levels. This is a bearish deterioration of breadth, as we just said. And here's the QQQE. You can see the same thing, breaking down underneath the balance range versus the weighted Qs, which are still inside of the range. So this is a bearish divergence, right? Again, I don't want to have to be any more bearish than I have to be. Usually, sky's the permeable of YouTube. Markets go up, the sellers fail over and over and over again, right? Well, hey, I mean, we're just reading the charts in front of them, or in front of us at face value. Let's go from breadth over to, hopefully this works, VIX. Oh, Thinkorswim, you're really going to be that way, huh? All right, we'll go over to VIX manually. VIX continues to remain elevated, right? Looks like the flex grid is broken. Remaining elevated on the VIX is not good. That continues to tell us that participants are fearful. Let's jump on over to the VVIX. That's too many V's. There we go. Just two, not three. VVIX, moving in the upward direction as well, staying over 120. That is bearish. Let's go on over to volatility. Let's go VIX 1 day. First, something like this, VIX 1 day continuing to move in the upward direction. That, again, a bearish indication. We don't want to see that in terms of comfort. And then for backwardation, I usually have that chart in the top pane up here. Thanks a lot, Thinkorswim, for ruining it, I believe. Let's go here. Yeah, really not going to allow for any of this. Let's see if I can detach. Oh, there's the workaround we were waiting for. Love that. If we detach the screen and take a look here, you've got yourself still a deep backwardation. Very deep in terms of backwardation. All that means is that the front month contract is higher than the back month contract, right? And if I just close that up and go over to the trade tab, let's go vol futures. Oh, play nice, Thinkorswim. Really having some issues here on the weekend, right? It just means that this number, obviously, 2659, is well above 2492. That is backwardation. You could go over here to product depth, and you could see that the curve is inverted. Typically, you want this curve in the opposite direction, telling us that there's lower volatility in the present day and more unknown risks on the future. This is completely backwards and telling us that money managers are not going to be willing to allocate capital until this reinverts, right? Nobody wants to be a buyer. Usually under the 50-day simple moving average, everybody's like, okay, risk off. Under the 200-day, forget about it, which we're knocking on the door of. So volatility complex is incorrect. Now, what I will say, when and if this inverts, that is going to have massive signal inside of it. And, that's one of the things that I'm going to be very closely watching if the market tries to make a turn. All right, so there's your volatility read. Let's go back on over to charts here. reset this as I lose my voice, perfect timing, and get into the core list of companies. So the first thing I'd point out on NVIDIA, there's some odd degree of relative strength here with lows, higher lows, riding the 200. Technically, although it looks like a bearish close, it is a bearish close on Friday, you've still got some odd possibility of a higher low, right? You're at least not breaking down through this like the S&P was. You're not even at these lows from over here, 171. Does that mean I'm just buying NVIDIA with both hands? No, absolutely not. And instead, I would think bearish consolidation in here. This opens the door for lower, and then we really get bearish underneath these lows. Lose 171, I think you're really going to start to see the head and shoulders on the weekly start to play out as a more meaningful data point, right? That goes, and I think it's goodbye, at least to here, prior left side peak, right? That seems a little bit more reasonable to me. Let's jump on from NVIDIA to Apple. Let's go back to a daily chart. Apple looks weak. Breaking down through these lows, 200 SMA seems like a reasonable test. It is a prior weekly pivot, and it is this low. I would pay attention to that for a possible counter trend bounce, right? When we get here, this is where you want to stage lower highs. So Apple's sequence is a little lower earlier. If we can find support for a counter trend, fine, lower high, and then continuation. If you lose the 200 via some sort of gap down through it, things get nasty, and they get nasty quick. Looking left, thin structure until you really come into this at 334.25. Right. Let's go on over to Microsoft. This is going to trade like the IGV. Not really the best close on Friday. Ideally, this would have stayed over the 20 SMA, and clearly we broke that. Doesn't mean that the inverted head and shoulders is completely lost. It may just be reconfigured for now, and maybe we have this kind of trend line happening here, left, head, right. I'd want to see it turn pretty rapidly. I don't love new shorts on Microsoft in here. For me, I'm more neutral Microsoft through this than even flipping bullish into the 50. If we do move lower, I mean, I'd have to concede that it's just bearish, right? There's no arguing with price, but I just don't know about personally wanting new shorts. You heard my same hesitation on the IGV. It's the same thing for me here over on Microsoft, noting that this is just the heaviest weight component, right? Let's go on over to Amazon. Nancy is back underneath this 212. Not too fond of that. Like Microsoft, I'm a little less compelled in here. I would be more bearish underneath 203.35. This was a balance range that resolved higher and then, of course, is now failing back in after a lower high here. So neutral through the balance, and if we're underneath, yeah, the gap down here potentially comes back into view as a potential target. 203.35 is the number to beat. If it's going to be upside, I would play ball on a recapture, whatever you want to call it, recapture, as we say, over 212. Not the worst thing in the world. So I still think, for me personally, maybe this is just my own bias on Amazon. Feel free to call it in the comments section if you'd like, whatever. This is something that I would be more interested in personally. Let's go on over to Google. I'm a little bit more short biased on Google just because it did not have its fall from grace. Of course, you have this big topping formation on the weekly, head and shoulders. Great lower high action this week off of the 20 SMA, looking for equal lows to ultimately give and get us down into this zone over here. So Google, probably still on the short radar underneath 296. Any rallies that get over 310.50, I'd reevaluate for just some better sideways action. Maybe this even builds out a high, stage. It's really, what do you get? Stage 3 high base that breaks to the top side instead of drifting into a stage 4. Get back into like an uptrend. Maybe it seems a little unlikely if the broad market's going to fall, but that's Google. Broadcom, a little disappointed in this name on Friday in particular, not being able to hold over that 336.50 area after reclaiming the moving average stack post earnings, right? So, I got to take it at face value. It just seems like another weak lower high here. If semis are going to be weak, I would stay away from Broadcom on the long side for sure, and focus more on SanDisk, MU on the memory front. So that's kind of that chart. Midpoint of this range doesn't really offer much for me here. If we're there, maybe it's a squeeze again back over 336.50, but I think the sellers have supplanted themselves again, or planted themselves, not supplanted themselves. And then in here, maybe that's the long. You got to just keep adjusting the goalpost a little bit over 354.80. Maybe this, builds sort of like a lower base down here, and, maybe it's this eventually. I just don't see it yet. Friday's close kind of nail in the coffin for this acting as a higher low. Let's move along to Metaverse. Chart's weak, breaking down from this as a bear flag on the gap and go from Thursday. It's still not my favorite chart to trade. I just got to be honest about that. These lows might offer a little bit of a bounce. I don't see Meta as offering anything that's kind of an A+ setup. If you were like higher time frame viewpoint of like, okay, this is lower high consolidation inside the prior breakout level, we're underneath the moving average. If you've been short Meta, I'm not going to complain about that. Like there's nothing wrong with having a little bit more of that short bias from Meta in here, rejecting the moving averages. I just personally don't like trading it intraday in this balance here. So I'm still sort of like, maybe it's a bounce on Meta off these lows for a scalp for the counter trend, or maybe it's like, let it go, comes back and rallies, here, gap fill reversals are short there. That's another situation that I would maybe be fond of on Meta. But for now, just kind of like hanging tight on that chart. Same thing on Tesla. Oh, think or swim. I am thinking more along the lines of a descending triangle on Tesla here to break and Brigade bolt underneath 386.50, getting us into 365. If we look left, we know that there's a volume pocket in here, a thin volume. Let's just break it out. Let's see if this doesn't break the platform. Let's go to weekly volume profile. There it is. Look at the low volume void. That's what you're looking to rotate through. Right there is the short trade on Tesla. So that's what I'm looking for, and anything that's just in here is noise to me. If it's going to flip bullish, you really got to start reclaiming this top end at 415. Let's hopefully, fingers crossed, not break it with JP Morgan. There we go. Let's get back to our daily moving averages. That's looking good. And what do we have over here? Just looks bearish, like the financials. Gap fill reversal up against that Wednesday low underneath the massive overhead supply. We know that they're trying to distance themselves from private credit, and the commentary from Jamie Dimon was like, earlier back in September, when you see one cockroach, there's many more, and they've unloaded a bunch of those portfolios. So we'll see if they can sort of find a little bit of a low in here, start to reclaim some of the upper levels. But for now, at face value, this is just a total rollover of the chart. You're in a stage 4 downtrend. Huge overhead supply. It looks ugly. If financials are lost, if JP Morgan's lost, you're not going to be higher in the S&P, right? Or it'll be very difficult to be. Palantir, they don't know if they want to treat this like software defense. No real follow through under the 150 for the neckline break of the hourly head and shoulders. And instead, I would start looking at this through the lens of a flag, maybe the first flag out of the base. This is very, very short term. Like, this is not true basing action. I'd be hard pressed to truly call that first flag out of the base. But if it goes, I'm not going to argue with that. I would not argue with it back into the 200 at 161.65, right? Palantir there, and Alex Karp really putting on a show, depending on how you think of it, on was it Friday when he was on that podcast? So interesting stuff. Nonetheless, I think price action alone will light the way over about 154.35. Let's move along to AMD. AMD continues to look weak here. These are highs. These are lower highs. These are lower highs. Equal lows. 200 SMA, you lose that. You're inside of the gap. Remember that this is not an earnings gap. This is the deal with OpenAI. So if you fail that, there's nothing there. And we already know that the market is very cautious of anything as it relates to OpenAI. Underneath this 188.80, losing the weekly left side pivot at 186.75, the door is open all the way down to 170.60. So that'll be a top priority to continue watching, just like Tesla, in terms of low volume void. In this case, it's even better on AMD with the gap underneath that level early in the week. Let's go to Robinhood. I don't like Robinhood shorts. I got to continue to be honest about that. I do believe in the thesis that there's just hordes and hordes of money that are going to move over to Robinhood as sort of fortunes or retirements or whatever just get passed along to the next generation. And not everybody, but many will move their money over to Robinhood. So generally, I don't want to be short into this left side peak. I do see that, yes, these are inverted hammers stacking back to back. I do see that, yes, you have thin structure here. I get it. I just don't. I'm not a believer that you're going to have, and market can prove me wrong here. And I'm just going to, the way I'm going to do this is by voicing what I'm saying here on this show is going to be reflected in my trading account by not shorting it into this level. I will not short Robinhood into this level, right? Maybe I miss a big opportunity here for a big downdraft on Robinhood. That's very possible, but that's kind of where I'm at. So I just want to be very clear, I do have a little bit of a bias on Robinhood as it relates to downside. If I try to remove that bias, this is just a bear flag. And if we come in here back to the daily chart, right, this is a failed breakout. Totally get it. Underneath the 20 SMA again. I get it. I see all the things. I'm not so woefully blind that I can't see it. It's not a trade for me. I will not be participating in that trade. Why is this? Where did our volume go? There's the volume subgraph. Perfect. All sorts of funky stuff with Thinkorswim today. Unbelievable. Hopefully in editing I could get a little bit of that out of there, but geez. Robinhood, I could see the argument for downside. I just will not be participating in that personally. I think that this is also trading like crypto, and if Bitcoin is trying to make a stand for higher, I don't want to be short Robinhood as crypto is trying to make a break out of its balance range. That also doesn't really make sense to me. So if anything, I haven't done it yet, but I would be willing to sell puts down at 60 or 50 or something like that. Willing to buy the stock down here, and if it just goes higher, then fine. Maybe I'll possibly add to my longer-term Robinhood position if that's going to be the case. So I don't want to fall in love with the stock, certainly if it's going to be dead and gone forever, but I just don't think that the thesis is completely gone. We've lightened the load a little bit, but I still think that thesis is on board. Anyway, That's that one. Enough talk about Robinhood. We've got 7 additional ideas. First one's on RTX, of course, not Rackspace, but Raytheon. And what do we have over here? I think fairly straightforward inside day. Doji there, 205.65, breaking over that probably gets you north into these local pivot highs. I could see this happening as soon as a gap up early in this upcoming week, Monday or something, if we get escalations over the weekend. If it does gap up, I would not buy it on a gap up. Look at how it acts on a gap up. Right? It goes sideways and then it pulls back. It closes the gap, it tries again, gap up, and then it goes lower, right? So I would not be buying this on a gap up, but I would be looking for, if we open in here, possibility to get back up to the equal high, just calling this a daily high or low, up against that level, 205.65 RTX. Let's go to Target, which is a little bit of an interesting one. It's certainly trying to reclaim some of its, dare I say, notoriety, but for a long while, it was like Target's way better than Walmart. And then it flipped, right? And then, I'm talking about the perception of the two retailers, right? Then it's, or I should say now, it's more like, okay, Walmart's way better than Target. Target sort of fell off, right? So I think the stock is trying to front run a return to glory, so to speak, in Target. You've got a nice uptrend happening here. We know consumer staples are strong. This has a beautiful, like if I just extend that a little further to the left, right? Look at the inside bar there. You could have this start to play as a daily high or low entry. Very, very tight price action, very small risk here if you could get that massive reward, just as a ratio, right? It's very good risk reward there at 117.85, and it's in sort of the right sector if we're going to be more defensive in this market. Now, keep in mind, long ideas in a falling market are just generally not going to be easy to execute. So I'm not saying Target's a walk in the park and, oh my God, this is free money. I just think the risk reward spot's very tight. If the broad market's down, it's going to be like pulling teeth, right? Let's go on over to eBay and see what eBay has for us. Same comment. If the broad market's falling, eBay is not going to, do anything special for you. It does have a small history of some nice moves, right? This was a fairly nice move here. This was a fairly nice move here. This was fairly nice. So it's got a history of some linear nice moves. They tend to be short-lived, as Jerome Powell would say. I'm just noticing the inside bar over the 50. It's got some relative strength. The broad market lows, higher lows, higher lows, higher lows, right, post earnings. So if you could get this break here over 93.25 into these equal highs, maybe there's something to do there on eBay. So just calling the bull flag after inverted head and shoulders post earnings, first flag over the reversal, right? Still staying over the 200 SMA. DELL, this on the other hand is clearly acting as perhaps even a new market leader here. Look at the relative strength. Look at it coming up and over these inside bar highs on the week. It's just higher. So as long as this could stay over 148.20 and consolidate here, I think you've got a very well-defined pivot, right? Just up and through that. You're probably talking about these prior left side highs here, close to 167.25. Sorry for not doing all of the homework beforehand, but there you go. Consolidation, even this is like fine, right? Ascending triangle, little wedge here. If the market finds a low, so again, same caveats that we've been talking about. If the broad market's down, this is going to be like pulling teeth. But if it's going to be strong, and if the broad market finds a turn, that's probably a decent opportunity through this thin structure breakdown here into that high at 167.25. DELL. All right, let's get on over to Murphy Oil, MUR. If I could type over here. All right, so we know that oil is likely to be higher on the Sunday night futures open. I would just pay attention to this on any pullbacks over about 35.55. There we go. Likely to gap up. If we could pull back, you don't want to buy it on the gap up. You want to buy it as it potentially finds a higher low as the moving averages creep back up. Is there some way to get long Murphy Oil on that? Notice on the Friday session, let's zoom like this. Big volume, right? So you could play it a couple of ways. High volume close. You could play the gap fill reversal in here. You could play up against the moving averages. I just think it's worth paying attention to. It's been in an okay trend. Obviously, the leader of the group is going to be your XOM. I just don't... Maybe you call this high tight flag that's starting to form. I just don't see an entry tactic here on XOM unless you were buying this against the 20 and already involved in it. So that's XOM. CVX is going to be very similar, right? There's really no entry tactic here. Could you say 3-bar play up and over the high? Maybe. So I don't know. MUR just came through the high volume scan, basically. Let's go to the two big ones, I think. SNDK, right? Worth paying attention to over here. SanDisk, the big watch here on Friday was the break of this trend line. A little bit lackluster because intraday, we have to admit, the first move was to back away from that. It was really the end of day rally that brought this back to life, and that was pretty impressive, noting that the broad market closed really weak and heavy. So on SanDisk, you probably have a lot of money that's going to come in here and chase this. If it starts to accelerate over the trend line, I would be paying very close attention to this, especially with MU earnings upcoming this week. This was another one that started to back off of the trend line early on in the session Friday, and then ended up closing strong. So I do have to give it a little bit more credit than maybe it deserved earlier on in the session, which was looking weak, right? If I just go back over here, notice how we came into the trend line. That lower wick of the second hourly bar was just suggesting that the daily bar was this, right? Or I guess the upper wick would be a little bit larger up to the high of day like that. So that wasn't looking good at first, but the close did end up pulling through here and looking okay. So MU and SanDisk, definitely the leaders there. Speaking of leaders, I know we did this on was it Wednesday or was it last Saturday? I can't even remember at this point, but let's go on over to LITE as well. A quick tour through the leaders at the bottom. Starting to go backside, lower high over here. I would just point out that, again, the darlings of the market are, some of them are okay, some of them are not okay. Some new ones are emerging, right? So there's LITE, here's CIEN. Oops, CIEN, if I got the order incorrect. This doesn't look as bad, but it doesn't look great, right? This inverted hammer on Friday. So darlings and fiber optics kind of unwinding a little bit. GLW, so for Corning, lower high under the 20 already. AAOI seems to be unstoppable, and like you can't really do anything here just to give it all back into the end of the week, right? So in my view, some of these fiber optic names might be handing the baton over to things, again, like SanDisk, MU, or maybe even DELL becomes a new one. And then really two of the newer ones, DOCN, right? This is DigitalOcean infrastructure. So, that's clearly big strength on that. Up and over 69.25 is a possible play on DOCN. But even if you just want to track it as a leader, right, the point is to continue to stay on top of the themes that are potentially acting the best for when the market does make a turn, or, right, if we're just looking, say, okay, do the leaders really crumble as the market falls apart? That would just tell you that, yeah, we're in store for a little bit further downside rather than an early turn, right? So DOCN and then Fastly has been another one of these names that can just do no harm in the market. Yeah, upper wicks here, but look at it continuing to charge in the upward direction, breaking out all last week, making another, what is that, like 25% move, give or take? Let's come in from Monday's low to here, close, yeah, 25%. So Fastly, another leader that's doing well. Okay, those are the names that I would say continue to be on the radar as what's doing well. VRT, also there, not as impressive of a week. I'm not going to call it a bad week, especially given the fate of the broad market, but VRT not quite as good as a Fastly, and DOCN, which really looks set up well. Okay, that's what I've got for you in today's episode and installation of the, not pre-market prep, but the weekend video. If you enjoyed or learned anything new in today's analysis, let me know down below in the comment section or by giving the video a very simple thumbs up. As always, we will be live for the pre-market prep episode and installation, always kicking off at 8 a.m. Eastern time every day here on the channel live, to give you the game plan and the keys to the kingdom for the day ahead. With that being said, have yourself a green trading week, and as always, I will see you in the next one.